The latest UK developments had a bit of a role to play in the overnight market volatility, which led to the Aussie dollar falling to a new 2.5-year low against the US dollar. But yeah, the British pound in particular copped a heavy beating. Another big overnight drop after Prime Minister Liz Truss fired the now former Chancellor Kwasi Kwarteng. Essentially, he's become the fall guy. He's seen as responsible for the mini budget, which briefly caused the British pound to fall to a record low a few weeks ago. Now they've got rid of him and they've made a U-turn on some other economic policies. All this is pretty bad for the UK government's credibility in the eyes of the market. So for more on this, let's bring in Suzanne Haddan, who's the Managing Director of BFG Financial Services. Morning, Suzanne.
Good morning.
So it's a bit of a humiliating back down for the UK government. That's a mild way of putting it. How do you think things will play out? Will things get better or worse?
I think what's happening is, you say, a bit of crisis of confidence. And it's probably not the last back down they'll need to do, because we still have the substantial personal tax cuts. What they're doing is confusing the market, because on one side they're lifting interest rates, home loans at 15-year highs, and on the other side they're stimulating it by buying back bonds. So this has a bit to play out yet.
Yeah, and also in terms of extreme volatility, we've got to talk about what's happening in US markets. Yesterday morning, for example, we saw huge gains and huge losses. So the Dow Jones at one point was down 500 points and it rallied 800 points afterwards, even though the latest US inflation figures came out showing inflation's at a 40-year high, and it confirms more big interest rate hikes to come. What's going on there?
I think it shows us that markets do run on fundamentals, whether that's profits, whether it's earnings, but it also runs on sentiment, and that can be the only explanation for that biggest turnaround in history. The reality is, inflation is with us, interest rate rises are likely. There's going to be more pain for investors in equity and bond markets, and that's not going to end anytime soon.
Yeah, and speaking of more pain for investors, people looking at their superannuation balances probably feeling a bit worried these days. What can they do about this volatility besides ride it out for the long term?
Well, it depends where they are in their life cycle. If you're a worker, what you need to do is make sure your employer is putting your super in at least monthly. That will average out the cost of buying more units in your super fund. If you're close to retirement and haven't got around to planning to where your assets should be sitting in retirement, think about redirecting some of your super contributions to cash, term deposit type investments, so you're building up a buffer ready for retirement. If you're in retirement, if you're on the age pension, check if you should be getting more with assets dropping. If you're not on it, check if you're entitled, but also make sure that your cash and term deposit monies are invested at the best rate, which you can get 4% for 12 months at the moment. The problem is, if you haven't planned, haven't got cash, haven't got term deposits, you're likely to have to sell at a bad time. My tip there, look at all your assets and maybe sell positions that you're overweight in. If you thought you should have 35% in Australian shares and you've got 40, that might be where you hit to get you through this difficult time.
You mentioned cash quite a bit, so cash is king, starting to look like?
Cash is king, and to be blunt, in retirement and pre-retirement, cash and term deposits are your safe haven. You should have at least 3 years of your money in that area. And when you're coming up to retirement, you might have to pay off your home loan. You've got to start planning at least 5 years before that D-Day, the retirement hits you.
Suzanne Haddan, thank you very much for your insights.
Thanks, David.